If you're an S-Corp owner, the most important number on the tax return isn't your revenue, it isn't your net profit, it's your salary. The IRS requires S-Corp shareholder employees to receive reasonable compensation for their services for the services they perform. That's not a suggestion, it's a requirement. And if the salary you're paying yourself doesn't hold up to scrutiny, the IRS can reclassify distributions as wages, assess back payroll taxes, and add penalties and interest that wipe out whatever savings the S-Corp was supposed to create. This is the number you can't guess on. If you're an S-Corp owner, the most important number on the tax return isn't your revenue, it isn't your net profit, it's your salary. The IRS requires S-Corp shareholder employees to receive reasonable compensation for the services they perform. That's not a suggestion, it's a requirement. And if the salary you're paying yourself doesn't hold up to scrutiny, the consequences go beyond a simple adjustment. The IRS can reclassify distributions as wages, assess back payroll taxes, and add penalties and interest that wipe out whatever savings the S-Corp was supposed to create. This is the number you can't guess on. Today we're covering what reasonable actually means, how the IRS evaluates it, what factors drive the determination, and how to document your salary decision so it's defensible if it's ever questioned. Welcome back. I'm Lauren Twitchell, enrolled agent, founder of Zero Fluff Books, and former IRS revenue agent. When I was at the IRS, officer compensation was one of the first things I looked at on a corporate return. A salary that's clearly too low relative to the business's revenue and the owner's role raises immediate questions, and those questions lead to deeper review. This episode matters because getting reasonable compensation wrong doesn't just create a tax problem, it undermines the entire basis of your S-Corp election. Let's start with what the IRS actually requires. The Internal Revenue Code requires that an S-Corp pay reasonable compensation to any shareholder who performs services for the corporation before the corporation can make non-wage distributions. In plain terms, you have to pay yourself a fair salary for the work you do before you take profit out as distributions. Reasonable compensation is what you'd have to pay someone in the open market to perform the same services you perform for your business. I call this the replacement test. If you stepped out of the business tomorrow and had to hire someone to do exactly what you do, same responsibilities, same hours, same skill level, what would that person cost? If you're a graphic designer running an S-Corp, what does a senior designer with your experience earn in your market? If you're a consultant, what do firms pay for the level of expertise you bring? As an S-Corp shareholder employee, you'll fill two roles simultaneously. The first role is employee. You perform services for the business. You manage operations, you serve clients, you do the work. That role requires compensation, a salary that reflects the value of those services. The second role is owner. You invested in the business. You took the risk. You built the brand. That role earns a return on investment, profit distributed to you as a shareholder. The IRS wants to make sure the employee role is fully compensated before the owner role starts receiving distributions. You can't skip the salary and take everything as distributions. The salary has to reflect the actual value of the services you provide. How does the IRS identify returns where reasonable compensation might be an issue? They use data. The IRS has access to industry benchmarks and statistical information about what officer compensation looks like for businesses of various sizes in various industries across various regions. When a return shows a salary that's significantly below those benchmarks, it stands out. There's no published ratio that triggers an automatic audit, but the imbalance between salary and distributions is visible on the return, and a significant imbalance invites questions. If your business generates $200,000 in profit and you're paying yourself $20,000, that gap is going to be difficult to justify. The IRS can reclassify distributions as wages, assess the payroll taxes that should have been paid, and add penalties and interest. The intent matters too. A salary genuinely based on market data but on the lower end is different from a salary clearly set to minimize payroll taxes. The documentation demonstrates which category you fall into. There are several factors the IRS and the courts use when evaluating reasonable compensation. Training and experience. Someone with 20 years of specialized experience commands a higher salary than someone 2 years in. Time and effort. How many hours a week are you working in the business? Duties and responsibilities. Are you the sole service provider, the salesperson, the bookkeeper, and the operations manager, or primarily in an oversight role? Comparable compensation in your market. What do employers in your area pay for similar roles? Revenue and complexity of the business. Managing a business with $2 million in revenue and multiple employees justifies a higher salary than a solo venture with $100,000. These factors should be documented. A reasonable compensation analysis is a written report that lays out your duties, your hours, the comparable market data, and the basis for the salary you've set. If an examiner asked how you determined your salary, the answer should be a documented analysis supported by data. One more point. Reasonable compensation isn't a number you set once and leave alone. As your business grows, your duties change. Your revenue increases, your responsibilities expand. The salary that was reasonable in year one may not be reasonable in year 3. Review your compensation annually. Make it part of your year-end planning. Here's the bottom line. Reasonable compensation is the foundation of your S-Corp's tax structure. The salary distribution split only works if the salary side is defensible. Set it based on market data, document it thoroughly, and review it every year. Before next week, look at what you actually do in your business. Write down your duties, your hours, and the scope of your responsibilities. Then compare that to what someone in a similar role earns in your market. That's the starting point. Next week, the operational reality of running an S-Corp, payroll mechanics, quarterly filings, distributions versus salary, and what happens when you elect before your business is ready. I'm Lauren Twitchell. Keep the fluff out of your books, and I'll see you next week.